back. You're watching Stock Watch with me, Nolutando Mtonti Mlambo, and joining me to take your stock-related questions tonight are Rowan Williams from Nitrogen Fund Managers and Ricus from PSG Whole in One Ruimsig. We are pre-recording today's episode, but do continue to send those questions through. You can send them via email at stockwatch@bdtv.co.za or via SMS to 41392 or on X. Make sure you use the hashtag Stockwatch. Good evening, gentlemen. How are you?
Hi there.
All right, we've got quite a bit to get through today, but it is a brand new week. So maybe let's reflect on the last 7 days. What on earth was all of that? Ricus, we'll start with you, just getting your thoughts and even on what we might anticipate for this week when it just comes to equities.
Broadly speaking, it's August, and August is your worst month statistically, specifically in US markets, and we saw that play out. So the volatilities in the US markets went sky high, and together with that you had huge oscillation in US share prices, and global markets basically followed that. I mean, there was some increased political risk, whether it be in the Middle East or in Ukraine, Russia, but I think it's half that time of the year with a lot of the US market on summer holidays, and that's going to continue until Labor Day, early September. And that's the story as far as I'm concerned.
Robin, would you like to add to that one?
So I think what we've had is a very strong run-up markets year to date, and that's off the back of, I guess, a lot of hype in the AI sector. The market breadth has not been very broad, so it's been quite concentrated, that run-up. So you had some of the stocks poised for potential disappointment in terms of earnings expectations, which I think happened. That coupled with the weak jobs figures, which indicated a weaker, maybe, US economy than people were anticipating. And that trumped any potential sort of rate hike expectations. So I think the market just taking a breather. Unfortunately, the Japanese central bank also raised rates, and just the timing was poor, so that added to the risk-off environment. So I think you had a market that was teed up for sort of potential disappointment and potential risk, and we saw a bout of that. But I think what is positive is sort of it stabilized fairly quickly, so that does mean there's still good underlying demand, notwithstanding sort of high prices and little spikes in the VIX and volatility. So market sort of upward trajectory does look intact for now.
Of course, we actually do have a question around volatility, Ricus, and you mentioned this, so let's go right with it here. And no name from the viewer, but asking if it's worth it to be following the volatility index and maybe even helping to interpret it at this time. I think especially if you're a retail investor, is it something that you should be concerned with?
Well, over the past number of years, any spike in volatility has been followed by the dip philosophy. One day that's not going to work, and we'll have, not, as I've said, your normal weak month in August, but, a spike in volatility will generally lead to a fall in stock prices, which, as I said, over the past few years have tended to say, well, go and buy the dip. And we've seen it play out. August is not finished yet, but we've seen it play out. We've had a spike in volatility, and was caused, after the event. You can look back and say, well, it's Japan, or it's this, or it's that. But in any given year, the US market tends to give back during the course of the year between 10 and 15% of its gains, or from its highs at least, for that year. And that is playing out at the moment. There's nothing that stops it from developing further to the downside, but thus far, it's not nice to be in this period, but it's not unusual. But then to answer as I've answered the viewer's question, when you get these volatility spikes, and there's nothing really that says this is something seriously wrong, this is COVID, this is Lehman Brothers, then go and take a look at things that you might have wanted to buy, but where the prices run away from you, and you'll probably be able to pick it up at lower levels.
Oh, I love that. Some optimism indeed there, Ricus. And then I want to come back to another question. Anonymous here, Rowan, they're asking about jitters still pertaining to the Japanese market. They do believe that it's an unnecessary panic, but they're also trying to figure out, what's happening with the US recession coming. What is that based on? I always say it's hard to anticipate a recession. We anticipated a recession throughout most of 2023. We're almost towards the end of 2024. We're speaking about anticipating a recession again.
Yeah, so I think what has been quite remarkable with this significant rate hikes is that in history, each time it has resulted in the US economy moving into a recession when you've had such steep rate hikes. And what has been on investors' lips, the question is whether the Fed this time could engineer a soft landing. So that means raising rates without pushing the economy into recession. And that seems like that was the case. And I think what is important that a recession, and the evidence of that is worse for stock prices than high interest rates. So interest rates high, expected to come down. That's supportive for continued stock price strength. But if the economy does move into recession, that would be negative, especially since the expectation is that it won't move into recession. So that was, I think, some of the shift of the market's expectations, rising the probability of a potential recession, although it doesn't look like that's the case. That remains the base case. So, but that is something for investors to continue to watch. If we do see a rapid slowdown in short-term economic indicators for the US economy, we can expect actually to see further weakness in the market there.
I'm keen to get into some company news now. I think there's two questions in one here, so maybe we can treat them separately. The first one is around Sasol. Now, I said I'd like the guests to take on Sasol earnings that came out this morning. Then they say, considering what's happening with PGMs, particularly with impairments. Now, that's why I say I think it's two totally maybe different issues here, but we can all, we'll see how we treat it, Rowan. What's your take on the stock firstly, and then perhaps on the commentary on the impairments? I think those impairment amounts were quite steep, Rowan. I see you nodding, so let's go with you. What are your thoughts here?
Yeah, so I mean, it has been sort of catching headlines. I mean, there's been a lot of impairments across a lot of companies, and that just shows the sort of medium-term tough operating environment. You've heard companies talking about a difficult operating environment globally, and that has resulted, I think, as you're seeing, in changing assumptions to very long-term projects. So Sasol in particular, I think the actual earnings number was in line with expectations, but the impairment, I think, worse than people anticipate, and that's why you're seeing the share price weakness today. So they're saying their long-run assumptions for these large commodity prices in the chemicals projects is lower going forward than they had previously projected in terms of the asset value, and they're having to mark down those asset values. So they're quite bearish. So that's sending a signal to the market that they can expect depressed prices for longer, which obviously depresses profitability. And so that, indicating a continued tough operating environment. And that's sort of the economic reality that companies are communicating to the investment community.
And I want to speak about Lake Charles, because, of course, some of these impairments concentrated in the US. A few years ago, we were speaking about Lake Charles. I think at some point we thought, okay, we've kind of taken in the bad news with Lake Charles. And now, like you're saying, Rowan, the macros aren't quite supportive, of the kinds of returns on projects that initially were thought to had. What does that tell us more about Lake Charles? Still more, I think, bad news that could emerge from that project?
Yes, so I think, again, investors expected that the company had taken its medicine with a previous write-down and that they had sort of valued it at a level that was sustainable. But what is becoming clear is that chemical prices, the commodity that Lake Charles, the plant, produces, remaining depressed. So we're seeing continued excess supply and sluggish demand. And as a result, they feel that they've had to take a second write-down because the prices are lower. The long-term range of those chemical prices are lower than in those estimates when they did that first write-down. So that is what, is effectively the write-down is for, and that is, obviously clearly negative because it means the longer-term cash flows are negative. The value of the business is lower than previously thought.
Ricus, would you like to add anything when it comes to Sasol?
No, I think Rowan is completely correct there. I think just, on the subject of write-downs, Sasol built that plant. Cost overruns and the price for the product that they get is not what they thought. Therefore, they have to write down. In the case of somebody like Impala, their write-downs is not because they decided to build a plant. Their write-downs is because of the fact that they have to maintain capital expenditure. They have to drill. They have to develop. They have to drill stopes. They have to maintain plants. So it's not as if they misallocated capital. It's just that the capital that they have to spend is not generating the revenue that they would like because the product that they sell and the PGMs are not favourable to them at the moment.
Maybe we can stay with industrials here, because let's talk about Argent Industrials. A question coming up on that one and the valuation at this time. After a rally, are we seeing Argent being fairly priced?
Well, the market thinks so because the rally is not stopping. I mean, it's as far as the market's concerned, whatever is priced in at the moment is still favourable because I see absolutely no hesitation in the share price itself. That's about as far as my knowledge of Argent is concerned.
And then let's talk Sibanye. Panel's views on Sibanye has been beaten up too much and our potential value investment, or is the low share price justified? Ricus, what are your thoughts on this one?
Well, I was talking about Impala just now with their existing assets. Sibanye is a little bit different. They allocated capital to new ventures, whether it be Stillwater, or whether it be their new metals side of things. So that's a huge capital investment, again, on an uncertain revenue outcome because you cannot predict the price of the product that they are, now spending all this capital on 4 or 5 years into the future. Therefore, if PGMs start moving in the right direction for them, or things like or the battery side of things, then you can get huge operational gearing out of those new ventures, which would be fantastic for the share price. But I'm not seeing that in their product market at the moment. So I don't think it's a safe place to be in unless you're super confident that lithium and platinum is going to work out for you.
Ricus, you mentioned a safe place to be. There's actually a question on a safety here. I just want to find it. What would be a safe investment bet at this point? I mean, I thought Bitcoin was, but look at what happened last week. There was panic there. That made me panic and I pulled out. It is from Anonymous. We don't have to talk crypto. We can just talk, I guess, safe places to be. Rowan, maybe you can take this one on.
Yeah, so I think as an investor, really what you want to be is in a good quality business. So a good quality business has long-term relevance. It has products or services that consumers want or need, or businesses, and can generate good margins and good cash flows from that. And so you want to find something that is at a reasonable value that will continue to grow in terms of cash flows, earnings, and is well managed, is relevant, has a sustainable competitive advantage. For me, that's the safest investment because it will continue to grow and create value. Speculative investments, that depends on a lot of different things, and a lot of it is sort of human nature, human emotion, which is inherently difficult to predict or understand. And so I think you can get it right if it's flavor of the month, a trend, but sort of if there's no long-term relevance to that, and crypto is complicated, it may have relevance, it may not, but it's not really a safe place to hide. I think bonds are clearly safe, but they're not that exciting. So a good quality business is going to be your best bet.
Ricus, anything you'd like to add to that one?
Not really,
Yeah.
but just to underline what Rowan has said, Bitcoin is not safe because it's volatile. Not that volatility is the only risk factor, but just because it's so volatile, it can, by definition, not be safe. As Rowan said, there's nothing exciting about bonds, but in the current interest rate environments where we are expecting rates to go down, it is probably also a very safe place. But if you want to stay safe without foregoing real capital gain, then what Rowan has said um, is the answer. It's a good business with decent cash flows and growing dividends.
Tristan actually sent a question on bonds, and maybe you've already touched on it, Ricus, but I'm going to make sure that we give him a comprehensive answer. He says, could the panel please explain how bond prices work as interest rates are likely to come down? South Africa bonds look attractive, yet if rates go down, what sort of capital gains is an investor likely to receive? And how big are the penalties for selling a long-term dated bond before maturity?
Yeah, I mean, I can weigh in. So bonds can be a good investment at the right time in the interest rate cycle. And at the moment, we're at a peak in rates, and it looks like they're going to come down. So importantly, bonds are typically fixed coupon, which means you're going to get that coupon no matter what interest rates do. So obviously, as interest rates come down, the value of that coupon is actually relatively higher. So bonds appreciate when rates come down because you're getting those fixed coupons. So I agree, and I think South African Treasuries bonds are a good place to be, and they do express value. And I think as rates come down, so they will appreciate in capital. And so you could get a healthy yield around 10%, say. Plus, I would think if rates come down at this point in the cycle, up to a 10% return. So that would be a 20% return. And it's just very unique because we're at the peak of the interest rate cycle. Otherwise, it would normally you just get the sort of bond yield. And also if rates rise, obviously your value of your bond drops. So I don't think there's any. You're not penalized if you buy it at the right point in the cycle and sell it at the right point in the cycle. You could see capital appreciation. If you sell at the wrong point in the cycle, you obviously could get a capital loss. But you probably have better, at this point, I would say is a good entry point for long-term bonds.
We have a question here from Wes. It's not really a question. All they've written is healthcare shares, Novo Nordisk versus Eli Lilly. So let's just talk about these two and putting them against each other. Maybe even trying to see if some of the behavior we've seen with tech stocks, similar to what we might see playing itself out with these specific counters. Keen to get your thoughts, Ricus?
Well, yeah, Lilly has outperformed Novo Nordisk over a very long period, strangely enough, even though all the hype is in Novo Nordisk, and I think for a reason, and that's their dominance in the weight loss market drugs. I'm not particularly fond of healthcare stocks because doesn't matter where they are listed or where they operate, there's always some government interference because it's an easy target to penalize a healthcare company in order to gain votes from your electorate. So there's always something that happens somewhere. But with this new surge in weight loss drugs, whether it be from Novo Nordisk or others in development, I think that's an interesting new field because so far I can't really see any downside to that. So either or, as far as I'm concerned, but at the right price, because as a result of and Rowan mentioned the enthusiasm in the market surrounding the products that they are selling, they might be a little bit pricey at the moment.
And Rowan, would you like to add to that one?
Yeah, so I think you have to look very closely at the relative prospects. I agree. I think Lilly has a sort of a better product line. There are sort of questions about the efficacy of the drugs. I mean, they clearly work, but what is the percentage effectiveness and obviously continued innovations and further product extensions. So I think Lilly is ahead there. But again, these type of investments, you have to look what's it baked in to the price, what sort of expectations. And if they are very high, it could be poised for disappointment, which was a case of Novo Nordisk. But I think this is a long-term trend. And yeah, I would prefer for Lilly at this point.
Another interesting one coming through here, no name, so we'll just say anonymous. Packaging companies, Impact versus Mondi versus Sappi. Let's talk about these three counts. I think Impact came out with numbers last week, but I'm keen to put the three against each other, Rowan.
Yeah, so I think what you've got is slightly different businesses. Impact is a small cap and South Africa focused. Sappi, global paper and dissolving wood pulp. Mondi, more global packaging and European centric maybe. So actually they're not that comparable. I think in terms of moving the needle, sort of Impact's the smallest, so it probably has the greatest potential. The results weren't that fantastic, quite muted demand in South Africa. The share price has been reasonably firm, notwithstanding sort of slightly disappointing results. The valuation is very low, and there is a potential, I guess, for some corporate action with Caxton as a large anchor shareholder there. So Sappi looks quite cheap at the moment. It has sort of come down significantly. I think market disappointed with their results. Mondi also came with the results, also a little bit low. So I think sort of, yeah, smallest business Impact and sort of maybe the greatest potential return and the safest probably investment at this point.
Then I must move on to another question coming through here on Tesla. It's from a tech enthusiast, came through during the break. Tesla has completely lost credibility with me. Am I missing something? Of course, it's. I've heard some people say it's actually the Magnificent Six because Tesla doesn't count anymore. Ricus, I'm keen to get your thoughts on this one.
I'm biased. I can't stand Musk, but I think there's something to be said for he will think of something that will boost the Tesla share price. But it is what it is, and maybe I'm wrong. But if your company policy towards your workforce is what it is, I cannot see that being a sustainable business model. I would rather be in something that is not so hugely dependent on the persona of its CEO.
Rowan, your thoughts on this one?
Yeah, I'd reiterate what Ricus has said. Yeah. There's a bit of a cult of Musk, so I think investors are sort of overplaying, Musk's influence and his sort of genius and his ability to continue to innovate over sort of economic realities that, demand for EVs is not as high as anticipated, and the new product development, the robo-taxis, is not happening as quickly as anticipated. Hence, the share is overvalued. It's been overvalued for some time, and it'll sort of price at a more realistic level, and that could be lead to further disappointment for long investors in Tesla.
Certainly a warning worth heeding to, gentlemen. Let's get into your stock picks now. Ricus, I'm keen to get your thoughts. Which counter are you loving this evening?
I was talking, we were talking earlier about the drop in the market over August, and I mentioned that companies come back to viable levels. One of those, I think, is Google. With volatility set to continue in August, September, and possibly a little bit of October, the price can drop further. I mean, on my chance, about 15% down possibility. But it's back to about a 2023 price earnings historically. I don't think the noise around the EU declaring it a monopoly is going to have that much of an effect. It might in fact sharpen Google, if I can call it Google's focus. And it's early days in AI. A lot of people are saying, yes, but we're spending a lot of money, we're not getting earnings from it. It's been a year. I mean, this is a long-term product. So I think Google at these prices, for the type of company and what they're involved with, probably not a bad price to start picking up some.
And Robin, which account are you loving today?
Yeah, we like ACI here. So it's a very long-term, long-invested chemicals group, and they do mining explosives as well. I think what is important that we're seeing a new management team, and they've taken quite a strong, hard strategic look at the business and looking to remodel the business to focus it on the mining side of the business, on the explosives and chemicals, and actually divest of a number of smaller businesses. So expect it to be a more focused, streamlined business that will benefit from the mining cycle and will improve its rating sort of in the medium term. It is quite a large restructuring that they're doing, so it will be take some time. So investors need to be patient, but we're backing management to deliver on that strategic remodeling of the business.
Well, James Hadachi, thank you for your time this evening. Always a pleasure having you here on Stockwatch. That's all for tonight's Stockwatch. Thanks to our guest, Rowan Williams from Nitrogen Fund Managers and Ricus from PSG Hole in One Ruimsig. Up next, the close. Stay tuned.